If a company expects bad news, does it wait until the cash leaves or does it record the expected loss earlier? In this video, I introduce loss accruals and I explain how they apply to customer returns, warranties, recalls, and receivable defaults. Let's refresh our understanding of accruals and deferrals. These are somewhat specific terms, but they just reflect the situation that the underlying economic events do not fully align in timing with the actual exchange of cash. We could have economic events that come before the exchange of cash, or we could have the exchange of cash that comes before the economic event. So accruals means statement recognition is rushed. We have the economic event and it is reflected in revenues and expenses, and the cash exchange follows in the future. Deferrals, on the other hand, means that the income statement recognition is slow, and we have the cash exchange that happens first, and then the economic events that lead to the recognition of revenues or expenses are going to happen in the future. In this video, we're going to focus on accruals, and specifically, we're going to focus on loss or accrued expenses. So the situation where the cash outflow is expected in the future, but it hasn't happened yet, and we're still going to have the reflection of this expectation on the income statement. In the accounting framework in the United States, we have a somewhat asymmetric recognition of our news. The expected positive and negative news are actually treated differently. In terms of gains, so positive events, we do not recognize them in expectation. Even if they are probable, we're still not going to recognize them in anticipation. We're going to wait until they actually occur, and only then, when the underlying event happens, it's going to be recognized on the financial statements. For example, let's say that you buy a piece of land and that land has since appreciated in value, and you're pretty certain that you're going to sell it in the future, and you're going to recognize a benefit because you bought it at the lower price and then you're going to be able to sell it at a higher price, but you still would not incorporate that in your financial statements today. Only when the actual economic event occurs, only when you sell the land and lock in that gain, that's when it's going to be recognized on the financial statements. However, that's not how we think about losses. So losses, and by loss, we mean an expected asset outflow. Typically, we're talking about an expected cash outflow, but it could mean other assets as well. So we're going to keep it general. So losses are going to be recognized not when they actually happened, but when it is reasonable that they're going to happen. So they're going to be recognized when they become probable. Now, we don't actually have a specific definition of probability. It's not mandated that probable means 50%, more likely than not. There's definitely discretion in terms of what a reasonable person interprets to be probable. But for now, we're going to leave that aside and just say that we come to the determination that the loss is probable and we can estimate the amount of the loss. That's when we record it without waiting for it to actually happen. So the general category that I'm going to call this are loss accruals. So again, these are the situations where we know that a bad event is going to happen in the future. We expect it. We come up with an estimate, but it hasn't occurred yet. I'm going to think of it as a bucket of bad news. In other words, if I know that something is going to impact my firm in the future, I am going to bite the bullet. I'm going to recognize the bad news today. I'm going to impact my financial statement. I'm going to fill this bucket. I'm going to fill this loss accrual. So let's talk about the specific dynamics a little bit. We have an economic event that occurs that's going to lead us to a reasonable expectation of asset outflows in the future. So something happens today that tells me, oh, I think this is going to cost me money in the future. When the firm determines that a loss is probable and it can estimate it, it will recognize a charge on the income statement. That will either be in the form of an expense or a contra revenue. And I'm going to show examples of both of those in future videos. So you will hit your profitability in expectation. At the same time, the firm will increase the loss accrual, and that will either be a liability on the balance sheet for a contra asset account on the balance sheet. So we are filling up our bucket of bad news. We're saying, we know this is going to happen in the future. I'm going to take the hit today. Now, at some point in the future, the bad event is actually going to occur. The asset outflow is going to take place. At that point in time, we are going to reduce our liability or reduce our contra asset account on the balance sheet, but we won't have additional impact in terms of the profitability on the income statement and in terms of the net assets on the balance sheet. So we create this bucket of bad news and expectation. We're saying, this is going to happen. I'm going to prepare for it. And then when it actually happens, we simply draw down from the bucket of bad news. Now, this is really important. I'm not talking about cash here. This is not saving for a rainy day to deal with the situation that's going to cost us money. This is a conceptual bucket of bad news, if you will. This is just letting your investors and letting the other stakeholders know that you are aware that there is a cash outflow or another asset outflow that's going to happen in the future. So giving them this notice of bad news as soon as it becomes probable, as soon as you can estimate it. And then in the future, as it actually occurs, everyone has already been prepared for it. There is no additional bad news that you are disclosing at that point. So let's go through several examples of typical events that would lead to a creation of a loss accrual like this. So the first example are customer returns. If a firm makes sales and if those sales have a return window associated with it, then it is reasonable to have an expectation that some of your customers are going to take advantage of the return policy and will come back with a return where they will demand their payment back and they will give you back the inventory. What does it mean in terms of your revenues? It means that even though you had sales of $100 million, you don't really get to keep all $100 million of those sales. You have some expectation based on your historical reality, based on understanding of your customers, that 1 or 2 or 5, however many percent maybe of your sales will be returned during the allowed return window. So what the firm is going to do is at the same period where they make the sales, so during the economic event that leads to the probable expectation of these returns in the future, they're going to fill up the return bucket. So they're going to increase a refund liability on the balance sheet, and they're going to do that by recognizing a contra revenue account called sales returns on the income statement. So a contra account is just a child account. It exists solely to offset the parent account. So for the situation of returns, the contra revenue sales returns say, hey, I know there's $100 million of sales, but I think some of them will come back as returns. So let's make sure we reflect that as well. Now, in the future period, some customers will come back and they will do a return and they will demand their payment back. And at that point in time, the company will give them the payment back. So they will either receive cash or an account receivable will be forgiven. And at the same time, the refund liability will also be reduced. So now we're drawing down on this bucket of bad news and saying, we knew that some customers are going to return the product. We didn't know which ones. Now we have specific customers that are actually doing the returns. That's okay. We prepared for this. We have this liability that we've built up, and now we're going to use it up. Another examples are the default of accounts receivable. And this is something that I'm going to tackle in a lot more detail in the next video. So whenever a firm makes credit sales, in other words, whenever you allow your customers to walk away and not pay you, and instead you plan to collect from them in the future, there is a possibility that some of the customers are going to default and you will not be able to collect that receivable. So it is the credit sale itself, that's the economic event that creates the probability that you're going to have a loss in the future, the probability that you will not be able to have a collection in the future. So it is during the period of the credit sales, it's an expectation that the company is going to recognize the bad news. They will increase a contra asset account called allowance for doubtful accounts. That is going to be a reduction to the total assets on the balance sheet. And at the same time, they will do that by recording an expense, typically called the bad debt expense, on the income statement. So again, even before customer defaults have occurred, a company will recognize these bad news that some defaults are going to happen in the future, and that will impact both the income statement and the balance sheet. What happens in the future when the firm identifies which specific receivable will not be collected? Well, we have prepared for this possibility. This allowance reflects the expectation that some of the customers are going to default. When they actually do, we're going to draw down on this bucket of bad news. We will reduce the amount in this contra asset allowance. We're not going to have an additional impact on the income statement. We're not going to have an additional profitability hit because we have already prepared for this eventuality. And this is simply the expectation being turned into reality. Another example of a very common loss reserves are warranty claims. If you are selling a product which has warranty coverage, then you have a reasonable expectation that some of the customers are going to come back and file warranty claims. So again, you are going to base this on an estimate of what you think your sales of these products with warranties are going to cost you in the future. And at the time of the economic event, which is the time of the sale, the period of the sale, you're going to recognize that these bad news are probably coming in the future. You're going to increase a warranty liability. That's your bucket of bad news in this situation. That's your loss accrual. And at the same time, you will do that by recognizing a warranty expense on the income statement. So again, you're hitting both your profitability on the income statement and reducing your net assets minus liability, by increasing this liability on the balance sheet. You do that in expectation. Eventually, some of the customers come back and say, yes, please service this particular product, and you have an asset outflow in order to satisfy those claims. What do you do at that point? You reduce the amount in the warranty liability. You have cash that's going to leave the company or other assets as well, but you have prepared for this situation. You have enough in your bucket of bad news, so now you're going to draw down on it. Again, just to reiterate, we're not talking about cash. This is more about the expectation, conceptual expectation of bad news, and making sure that your financial statements have reflected it because you knew they were coming. Last example here, and this one is a little bit different because receivable defaults and sales return and warranty claims, these tend to be very much expected. Pretty much if you have a physical product, you're probably dealing with those situations. If you have credit sales, you're probably dealing with those situations. But the same thing applies to more unusual situations, such as a product recall. You could be a company that goes along for many, many years, never having a product recall. And then something happens, so you have an economic event that says, hey, a specific product that you sold has a problem, you need to do a recall. When the management determines that they need to undertake a recall campaign, and they have an estimate in terms of how much this recall campaign is going to cost them, they're going to recognize this on the financial statements. So even before they have started paying for the recall, or even before they have completed the payment for the recall, a lot of times this is kind of a lengthy process. At the moment that they decide that, yes, this is going to happen, we're going to do this, and this is how much approximately it's going to cost us, they're going to create a liability called recall liability on the balance sheet, and they're going to recognize a charge corresponding to the expected recall cost. So it's going to be called something like a recall expense on the income statement. Now, in the future, as they're actually doing the recall, as they are paying the money in order to get it done, they will reduce this bucket, they will reduce the recall liability as they are incurring the actual costs to deal with this situation. So again, it doesn't really matter if this is something that you expect to happen every single quarter, or if this is a one-off situation. The logic still stands. If you have a loss that is probable and estimable, you're going to recognize it on your financial statements. And then when it actually happens, you have already prepared for this. You have created this bucket of bad news, and now you're just going to use it up. You're going to draw down on this loss accrual as the news actually materialize. I said that when the asset outflow actually occurs, you're not going to have a further impact, but that has a very important assumption in it. This assumes that your loss estimate was sufficient. That means that you have correctly predicted how much the outflow is going to be. Is it possible that you have misestimated the future costs? Absolutely. Sometimes it is difficult to estimate these things. Now, what's going to happen if you did not estimate correctly, that means you're going to catch up. So you could have a situation that you were overly optimistic, that you did not put enough losses in your loss accrual bucket, in which case you have a situation that the bad news occur and they're more severe than you anticipated. In that case, you are going to have to catch up and you will have additional hits to your net income, additional charges that draw down your profitability, and additional impact on your balance sheet as well, on the net assets as well. Now, you could have an opposite situation. You could have a situation that you were overly pessimistic. So you thought that the recall is going to cost you a lot more than it's actually costing you, in which case you have too many bad news in your loss accrual bucket. It's overflowing. In that situation, GAAP accounting is going to allow you to adjust this bucket, and you are going to reverse some of this, or you're going to reduce the additional amount that you're putting into it. In the future videos, when I deal with specific transactions, I will show examples of each one of these. For example, in the next video, when I talk about accounts receivable and the expectation of default, I will show examples of firms that disclose the situation where the actual defaults came in and they were higher than anticipated, and the situation where the actual defaults are coming in and they're actually lower than anticipated. There we have it, a basic introduction to loss accruals. The underlying intuition is that we have asymmetric recognition of gains and losses. Gains are not recognized until they actually occur, but losses are recognized when they become probable and we can reasonably estimate them. In future videos, I will give specific examples of situations that I've talked about, so receivables, the returns, the warranties, etc. So stay tuned in terms of actual disclosures of firms that are dealing with these issues. I hope you enjoyed this video. Please like, subscribe, drop me a comment if there's specific topics or questions you would like me to cover, and share it with your colleagues and friends. I'll see you in the next one.